The Banking Regulation Amendment Ordinance 2017 was promulgated on the 4th of May 2017. It amends the Banking Regulation Act 1949, which governs the manner in which banks are supposed to function and specifies aspects such as their licensing, operations, and management. Over the last few years, India has witnessed a rising trend in loan defaults. These non-performing assets of banks as a proportion of total loans given by them have increased from 2.3% in 2008 to 7.5% in 2016. In case of a default, typically banks have the option of restructuring a loan, possibly by changing its repayment schedule. In case there are multiple banks involved, they could formulate a recovery plan under RBI schemes, which allow them to take over the management of a business, among other options. Banks may also choose to initiate proceedings in debt recovery tribunals or under the newly enacted Insolvency and Bankruptcy Code. The ordinance allows the central government to authorize the Reserve Bank of India to direct banks for initiating recovery proceedings against loan defaulters. These proceedings will be under the recently enacted Insolvency and Bankruptcy Code 2016, which allows for a time-bound 180-day recovery process. Under the code, lenders may decide to either restructure the loan or liquidate the business and recover their outstanding dues by selling its assets such as machinery, land, and properties. The powers given to the RBI under the ordinance raise a few questions. 1. Did the RBI need these powers to be given to it, or did they already exist under the Banking Regulation Act 1949? For example, when one looks at the 1949 Act, Section 35A allows the RBI to direct banks in case of public interest or where the functioning of the bank is detrimental to the interests of the consumers. NPAs affects the availability of credit in the country and has broader economic consequences. In such a scenario, could the RBI have directed banks to initiate recovery proceedings under the Insolvency and Bankruptcy Code, citing public interest? Another question to think about is that about 88% of the NPAs are in public sector banks where the government is a majority shareholder. Therefore, one could argue that the government had the authority to direct these banks for initiating recovery proceedings against loan defaulters without involving the RBI. Second major question that arises is, to what extent is the RBI justified in directing banks? There are two arguments in this case. One argument is that as the regulator, the RBI's role should be limited to formulating broad policies and guidelines for banks to comply with. The banks should have the independence to take business decisions. For example, who should they be lending to, at what rates should loan be given, or what method should be used for loan recovery, as this affects the amount banks can recover from a defaulter. Under the ordinance, the RBI directions to initiate recovery proceedings against defaulters may be at variance with the decision taken by banks. For example, there may be cases where the banks have decided to not initiate recovery proceedings in the hope that once the business cycle improves, the company will be able to give a higher repayment of the loan. However, another argument is that the RBI as the banking regulator is responsible for financial stability in the country. A rising trend in NPAs may have an adverse impact on the economy as it affects credit availability and investment. Therefore, the RBI's intervention and directions may be required to resolve the situation and facilitate the bank's efforts in loan recovery. Lastly, one may also question whether the ordinance will be able to resolve some of the other challenges faced by bankers after initiating recovery proceedings. There may be fears that anti-corruption agencies will question decisions taken by bankers to recover outstanding amounts. For example, the agencies could question whether the bankers could negotiate for an 80% recovery instead of accepting a 70% recovery. Another issue to think about is the insufficiency of capital with banks to absorb losses on account of writing off loans. For more details on the ordinance and other bills, visit us at www.prsindia.org.